So before we get into lessor accounting, so looking at the other side of the transaction, what I wanted to show you was another reason why companies would prefer operating leases as opposed to finance leases. Now, I don't want to use the example that we had because it ends up being, just because of the nature of the example, not as clean of a way of doing this. So I'm going to set up a new lease to show you how this works. So what we have here is a situation where we've already got an implicit rate. So we're just assuming a 10% rate. We're assuming there are cash flows of $10,000 a year in arrears, and there are 10 years worth of cash flows. There is no guaranteed residual. So the lease term is 10 years, the useful life is 10 years. As I said, I'll make this available after the fact. So the idea is just to kind of to see what I'm doing and make sure you're comfortable with how that works. So we need to get the present value of the minimum lease payments, which is what these are. And we're just going to assume that's also the same as the fair value of the lease asset, I should say. And what we've ended up with is discounting those cash flows at 10% gives us a net present value of about $61,000. That is the liability that we'd pick up. The cash flow is the $10,000. The interest rate is the opening balance at the rate that we've got there. The change is obviously just the difference between those two, and the closing is the opening minus the change. Don't need that last row. And voila. Obviously a lot easier than doing it by hand in an exam, granted. But what we've ended up with is a 10-year lease amortization, lease liability amortization schedule. You can see that we end up at 0 at the end. So the things I just want to focus on are, okay, we see the opening, we know where that came from. That's like what we've done before. The cash flows are just the cash flows we've done before. We can see the interest, and this is where we're starting to find something of interest here. The interest declines over time. So that is the interest expense which is going through the profit and loss statement. That will become lower and lower as the years go by because you're slowly chipping away at the lease liability. It's not to say the cash flows are changing. So again, it's the same deal with a mortgage. If you keep the mortgage repayments the same, the early years, most of that repayment is going off to paying off the interest on the loan. But as you move through time, more and more of that is dropping off the actual principal of the loan. The change is obviously how much you're paying off the principal, and we end up with a balance of 0 at the end, which is what we want. Now what I want to pick up is we have an interest expense. So these are profit and loss impacts, interest and depreciation. We have an interest expense of a certain amount per year. Because we've got an asset on our books, and that asset is coming on at $61,446, we also have depreciation. Oops. And if we add those two together, we will get the total expense for a finance lease. So that's what we're trying to pick up here. What color? Let me see that green. So I hope you can see with the finance lease, the expense that we're going to be recognizing in relation to that lease is $12,289 to start with, and that will slowly drop over time because the interest expense is dropping over time, ending up with a final yearly expense of $7,053. The operating lease expense, as we've seen earlier, is simply the cash flows that you've got from that. So the operating lease expense is $10,000 a year over those 10 years. Now I'm going to do this graphically as well because you can see what's happening here, but I want to pick it up in a chart. I just want to sum the total amount of that together. So with a finance lease, when you add up the total expenses over the 10 years, you have $100,000 of expenses in relation to that lease. And when you see it for an operating lease, we have a total of $100,000 in expenses for the operating lease. So we have the same total expenses over 10 years, which is not surprising because in this case, in the finance lease, we end up with an asset worth nothing, and we've paid out $61 million worth of, sorry, we paid out $100,000 worth of cash. In the operating lease, we end up with an asset of zero because we never had it, and we paid out $100,000 worth of cash. So in each case, we've had a $100,000 impact. That's the format axis. Sorry. Those lines are quite skinny, but they'll work. You'll see the blue line starts at about $12,000 expense, works down to about $7,000. The red line just stays constant at 10. When the blue line is higher, that means the total amount of expense for a finance lease is higher than the total amount of expense for an operating lease for each year for the first 5 years. So during this period of time, you're going to show greater profitability if you've accounted for this as an operating lease. Over the remaining 5 years, that finance lease cost or the expense of it drops below the operating lease because you're paying less interest expense or recognizing a lower interest expense. So early years, there are benefits from a profit point of view to showing this type of lease as an operating lease. So if it can be structured so it will look like an operating lease and be classified as an operating lease, you will have a better profit in those first 5 years. And when we look at it, you could be in charge and be here setting this up. Those first 9 years, now if you can, it's pretty small down the bottom, but those first 9 years, if anyone can see this in the room, I'd be surprised. That equals to $92,946. So there will be $92,000 worth of expenses across the first 9 years of a finance lease, as opposed to $90,000 of expenses for the first 9 years of an operating lease. So if you're being judged on profitability, your profit is lower if you're going to get a lower total profit cumulatively over those 9 years if you've gone down down a finance lease path. So if you leave any time before that lease is finished, you've actually kind of left profit on the table had you done this like an operating lease. So there's a really strong profit and loss incentive and profitability incentive to classify something as an operating lease if you can. So it's not just the balance sheet impacts that you're looking at, it's also the profitability impacts that you're looking at. Yes?
If you start classifying it as an operating lease from the start, do you have to remain classifying it as that type of lease throughout its useful life and you switch to a finance lease halfway through?
I'd imagine there'd have to be there'd have to be a change in the actual arrangement, I would imagine. I mean, it wouldn't just be rolling along and then you go, okay, just arbitrarily, let's change it. Like you'd have to have a change in circumstances to lead to that. Now, I am sure there are probably situations where that crops up. It's not one that we look at, but you'd have to look at, how the actual economics change. So, I mean, if the lease structure changes, like it couldn't just be randomly go along and then, okay, now we're just changing it. Like you'd have to have an actual reason for it.
There's more profitability to use the operating lease in the short term. And then
so just use it in operating and then change it to a finance. I don't think, because when you set it up, I don't think that, because basically you don't have control at that point, and then when you do get control, then you're recognizing an asset and liability based on what the facts are from that point on. So I haven't thought through in my head how that would actually look, but I'd imagine you're not going to just suddenly go, let's show these and then switch over and pick up those ones. I mean, it's obviously, I'd imagine people have thought about trying to get that structured, and there may well be ways to do it, but it's not something that we're not going to see changes in classification of leases here. But yeah, like have a look and see if you can find something. See if you can have a look in the standards if they talk about changes in lease classification. Talk to people at work if they know if this is a situation. But certainly it's an interesting one to think about for sure. But assuming we don't have that, then yeah, like this works a lot better earlier on. Now, lessors, this is looking at the party that provided the lease. So they're the ones who provided the lease asset, which means if it's a finance lease, they are giving something up. Their asset has to go because they don't control that asset anymore. Now, for the most part, this is actually done exactly the same with one difference, and we're going to pick up what that is. So initial measurement, lessor shall recognize assets held under a finance lease as a receivable at an amount equal to the net investment in the lease. So I leased those R8s to all of you guys. It's a finance lease. You guys all owe me money. I have a receivable from you. I pick it up as a lease receivable. All those cars go off my balance sheet and I get lease receivables in return. But this idea of a net investment in the lease, this is something new and we haven't seen it yet. So the net investment in the lease, we have to look at how that's defined, and you go to that definition, and the net investment is the gross investment discounted. So we've got to have a look at what the gross investment is. And the gross investment is comprised of two things. The first of which we've seen. That is the minimum lease payments. So that is, let's ignore the bargain purchase on the cars that I gave you before. I'm not that nice a person. Okay, that seems a bit silly. You guys pay me, you have your regular periodic payments. There's no balloon payment on it, you will just give the cars back to me. So you'll use it for 3 years, pay me that, give it back. Now, the minimum lease payments are your regular payments across those 3 years. That's what you're paying me. The last bit, but this is something for me to think of in relation to the asset that I have. The asset that I have is not in relation to these cars, is not just the money that you're going to pay me, it's also what you're going to pay me plus what I can get for this car when I get it back. So if I think this car is going to be worth $200,000 when I get it back from you, I include that as part of the asset that I show because it is, I believe, going to be a cash flow for me. So you guys pay me $50,000 a year for 3 years to use this car. So you'd have those 3 payments of $50,000. I'd get a discount value of that, which is, let's say, $110,000. So $110,000 would be the present value of the minimum lease payments. That I know I'm getting from you guys. You guys would show that on your books as the lease asset and lease liability. I get that 110, but then I think at the end of that 3 years, I can sell that car for 200, or I could lease it out to someone else and use 200 as the present value, the value of the car. That's an asset to me. That's what I think should be added to it. So I would then discount that 300,000, what was it, 200,000? So those are the minimum lease payments. And I have no idea what the interest rate is, but let's just say that works out to be 110 in terms of the present value. That is what you guys show. That's also the first component of the gross investment. I then look at what I think I could get for that car or what it's worth. And that, let's say, is $200,000, which is the unguaranteed residual. I don't know, what should we put in here? Obviously, this is going to use a different discount rate, but let's just say it's 120 as the present value. We're going to put big question marks about these because they're obviously just made up numbers. So for me, I would have an asset of $230,000 because it's the cash flows from you plus what I think I'm going to get somewhere else. You guys are only showing the cash flows that you're giving up, not what I think I'm going to get from somewhere else. That's the important bit. So it's the unguaranteed residual, which is the difference. The recognition of finance income shall be based on a pattern reflecting a constant periodic rate of return on the lessor's net investment in the lease. That looks really similar to the terminology we saw on the other side. So that's pretty much just splitting up the money that I get from you guys and splitting it between the reduction in the receivable and the revenue that I get. And I know we've just flicked off it, but let's just flick back and we shall see. So from a point of view of a lessor, In this case, there was no unguaranteed residual. The guaranteed residual is part of minimum lease payments, so we do include that. So lease receivable, the asset is because you've given it up. That is the net investment. We're splitting up the cash payment into reduction in the receivable versus the revenue. So this is a profit and loss effect from it. This is just reducing the lease asset. And then when you guys keep the asset and just pay me cash, I get $50,000 in cash and the lease receivable disappears, and I've got a whole bunch of cash from you guys. I don't have an asset anymore, and you guys keep the asset. So that's, in this case, because there was no unguaranteed residual, it is literally the mirror image. And I'm going to, instead of flicking back and forth, the next slide around the operating leases for lessors. Lessors shall present assets subject to operating leases in their statements of financial position according to the nature of the asset. I keep the asset. So if I'm Video Easy and I'm renting out DVDs, physical DVDs, that DVD stays on my balance sheet. It's not going, I haven't passed over control, passed over sort of, this idea of you guys having the risks and rewards of ownership. I've kept it, so it's on my books, and I recognize operating leases on a straight line basis, the income from it on a straight line basis over the lease term. So it is simply debit cash, credit revenue. So it would be debit cash 16.1, credit revenue 16.1. That's it. The asset never disappeared. We show the payments as they come in, and that's all that happens.